Let's run through some multiple choice questions here on capital structure and management. To begin, which of the following would never be included in the WACC formula, also known as the weighted average cost of capital formula? And for something like this, really the best way to approach it is, well, what is the formula? What's the formula? Because obviously one of these is going to not be included there. So WACC equals cost of debt times its weight plus cost of equity times its weight plus, not all the time, but sometimes it could have cost of preferred stock times its weight. This is a formula you should definitely be familiar with. If you don't know it, make it a priority to familiarize yourself with it. Now, let's dive in. We're going to have to talk about this a little bit further. This is actually the after-tax cost of debt. After-tax cost of debt. And I just usually summarize it, just say cost of debt for brevity purposes. But because of that, the tax rate will be included because we need the after-tax cost of debt. Okay, great. So that's going to eliminate letter D for us. Well, what about the required rate of return? What is that? The required rate of return is another way of saying the cost of equity, because what is the rate of return we need to earn on our own stock? That is essentially the cost of issuing that stock. To beat it to death here, if we issue stock and we need to earn at least 20% on whatever we're issuing the stock to raise money for, that's our cost of equity. And just to elaborate further, let's say we issue $20 million worth of stock. We're going to put that $20 million into a machine, a very expensive machine. If we hope that machine makes us 20%, that is now the cost of equity. That's the cost of the equity of the $20 million of shares that we've now issued. So that is the required rate of return. It is involved in the cost of equity, and as such, it is included and is not one of our answers here. Lastly, the summed market values of a firm's capital structure. How do you get the weights for all of these? Well, through the market values of the capital structure. If we have, let's say, 1 million of debt, 2 million of equity, and 3 million of preferred stock, this is a total market cap of $6 million. Now, how do you get the percentages, the weights? You do 1 divided by 6, 2 divided by 6, 3 divided by 6, and that's how you get your weights. As such, summed market values of a firm's capital structure, for sure, we're going to include, and as such, it is not an answer here, leaving us with, finally, the risk. Now, risk, you do see this in the CAPM formula, which the CAPM formula is a way of calculating the cost of equity. However, the risk is not involved in our actual WACC calculation. Awesome. Final answer is letter C. Using the capital asset pricing model, as I just mentioned, it is the CAPM formula. And as soon as you see any formula mentioned in any question in this entire exam, I am for sure going to recommend that you write it out. That is going to be your best bet. And your CAPM formula, should have this memorized, is the risk-free rate plus your beta times the market rate minus the risk-free rate. Great. And I'll talk about it a little bit further, but at the very least, definitely have this memorized. Without a doubt, you need this memorized. And what are we doing here? This is another name for this is the market risk premium. And why is that? The market rate is what overall people are earning in the market, right? If generally let's say the S&P 500 is returning 10% a year, our market rate would be 10%. The risk-free rate is the rate at which you literally could do nothing and you take zero risk and you still make money. So let's say that's 2%. So I'm making this up right now, just to elaborate, build in this question. 10% the S&P is making, 2% risk-free rate. So the market risk premium, by putting your money in the market, you're essentially earning 8%. That's the premium over the risk-free rate that you're earning. So if a question might say the market risk premium is 8%, you're not going to do the minus here. You're going to have just 8%, right? You're going to put just that market risk premium in the parentheses here. Your beta, this is going to be the volatility of the stock, right? Remember, we have the volatility of the stock. implemented into our formula, and then you add back the risk-free rate because you subtract out the risk-free rate here. You wanted to apply the beta, the volatility rate to it, and then you're adding the risk-free rate back in. So here, it's simple plug and chug. That is what I'm going to say. Lots of free points in the exam if you just memorize these formulas. So beta is 1.25. Remember to not round that. This is not a percentage. Don't move the decimal point. You just leave it as is. However, for the market rate, it's 0.14. Risk-free rate, 0.06. Again, risk-free rate here is 0.06. Great. That's all there is to it. Nothing really here to trip you up. Do the math. Give you a second to figure it out. Going once, going twice. Pause the video if you need a little bit more time. And final answer is going to be 16%. It's our math here, right? Nothing too crazy. Hope you did well there. And let's keep moving on. Let's take a look here. Well, a corporation has $50,000 in equity and a debt to total asset ratio of 0.5. The firm wants to reduce this ratio to 0.2 by selling new common stock and using the proceeds to repay principal on outstanding long-term debt. What amount of equity financing must the corporation obtain to accomplish this objective? Lots of great content here, practice. This one's a little tricky, and that's why we're going to walk through it. We mention a lot of assets, liabilities, and equity. Immediately, I'm thinking, let's write out some formulas. Assets equals liabilities plus equity. Good old accounting equation. We also see the debt to total assets ratio, which is just simply debt divided by assets, equals, in this case, 0.5. Right? So we want to reduce that ratio to 0.2. It's really good practice whenever you see anything that hints at a formula or just straight out says a formula to just write them out. These are tools that you can use to solve the questions. So we have these written out here, and let's figure out our liability amount, right? Let's figure out our assets. We know equity. We have equity of 50. Cool. And we know debt divided by assets is 0.5. So we can actually use these to solve. And let's put our thinking caps on. What's another way to rewrite the accounting equation? Well, I actually see that we can do, and let's say liabilities divided by assets for clarity. We can actually do A minus 50,000 equals L. So we'll do that. A minus 50,000, we subtract 50,000 from both sides, equals liabilities. We can then plug this in to our debt to total assets. So A minus 50,000 divided by A gives us 0.5. Cool. With that, we just need to solve for A. And give you a second to think about it. What could we subtract? So we basically, right, we know we need a number that'll give us the 0.5. What's half? So here, spoiler alert, we're going to just double this. We're going to double this to get to 100,000 because if you double it, it'll give you 0.5 divided by 100,000. So 100,000 minus 50 gives us just 50. 50 divided by 100 gives us 0.5. Now, what do we know with that? We know that assets are 100,000, and because of that, liabilities must be 50,000 as well. Awesome. Wonderful there. We also need to think about our relationships between all of these because what are some journal entries? Well, when we issue equity, we want to issue equity. It says it right here. We want to sell new common stock and use the proceeds to repay principal on outstanding debt. Generally speaking, well, not generally speaking, I mean, when you issue debt, when you issue equity, you're going to debit cash. Let's say we issue 50,000 more debt. We're going to credit common stock for 50. So that would increase both our equity and assets. However, we see this here, and it says we want to reduce our outstanding long-term debt. So actually, what would happen when we issue the common stock, yes, we would get cash, and yes, we would then use the cash to pay down our liabilities. But to skip that step, this is essentially what our journal entry is going to say. We're going to debit liability by 50, or whatever the number is, that's our answer. And then we're going to credit common stock because we're reducing liability, but we're increasing equity. Awesome. We just got to find this number. It's not 50. I just use that. It's X and X. We got to figure that out. So we need to, so we're assuming our assets are staying the same. We're going to increase this number and decrease our liabilities. That's what we're doing here. How are we going to do that? Well, liabilities divided by assets, so liabilities divided by 100 equals 0.5. So we started with 50, right? We started with 50. We want to get this to 0.2, right? Let's take a look at what we need to do here. So and this is in addition to what's currently outstanding. Now, to be honest, I would just try all 4 of these numbers out. We'll start at the top with 30,000. So what happens if we take 30,000 as our number, we issue 30,000 more equity, we reduce this by 30,000. So current debt, current liabilities is 50. If we reduce that by 30, that gives us 20. Wouldn't you know it? 20,000 divided by 100,000 gives us 0.2. Wow, wonderful. That actually, yeah, it's the first answer, and that looks to be correct. But let's just run through the other ones just to show you. So what if we actually do 20,000 instead? So this was originally 50. This would bring us to 30, and 30 divided by 100 is 0.3. So not our answer. And I mean, to be honest, you can also see that everything else is higher, so it's not going to bring us to that proper 0.2. I mean, if we do 100,000, this is actually going to make us go negative, and 80 would make us go negative, so that wouldn't give us our answer either. So final answer here is going to be 30,000. We are going to do this journal entry. This is our journal entry right here. Reducing liability by 30 and increasing equity by 30. And that gives us our final answer of 0.2. And these numbers are adjusted. We now have 100 of assets. We now have total liabilities of 20. And we would have increased common stock by 30, which is 80. Sums up to 100. Double check your math, right? Use all your formulas to triple, quadruple check your math. Make sure you got it right. Final answer here is $30,000. That one was a doozy. Super good question, though. I think this is very important to practice all of your good old formulas and see how even formulas you might not expect to come in will come into play in these questions. We're wrapping it up here with a question on the dividend growth model. Again, we see a formula, and I want you to write that formula out as soon as you see it. According to the dividend growth model, what is the investor's required rate of return? Dividends are equal to $5, current share price of 50. Dividends are expected to grow at 2% forever. Let's take a look. First step is we are going to write out the dividend growth model formula. That's P equals D. I'll use that for the multiplication times 1 plus the growth rate divided by the required rate of return minus the growth rate. Here is our formula. If that was not familiar in your mind, write this down on your cheat sheet, on your flashcards, however you plan on memorizing formulas, and make sure that one gets down as well. Awesome. Now we are going to do a little plug and chug. In practice here, the actual formula uses the next dividend to calculate, not the current dividend. That's a trick. And that's why we practice here, right? If you just read textbooks or you just had this conceptually, you wouldn't know that. But why is that? Why do we use the next period's dividend, actually? Because you might think we're just going to do our 5%, but that's not the case. Not 5%, our $5 dividend. That's not the case because here, a whole period has passed. We're assuming that a whole year has passed. That's an assumption of the formula. So we're going to take $5 dividend. We're going to add the 2% growth rate to it, so times 1.02. So you see there, that's accounting for one whole year of growth for your dividend. It's not just saying the current dividend. So that is actually going to get us to a dividend next year, but a whole year's passed, of $5.10. Awesome. From there, that's our dividend, $5.10. Multiply that by 1 plus the growth rate. So that gets us 0.2 again, so that's 1.02. Awesome. Now, what's our required rate of return? Share price is P, so we'll plug that in, 50. Awesome. Okay, we'll do a little multiplication. So 5.1 times 1.02 gets us to 5.202. Just say 5.2. All right, we got that there. Growth rate, we'll plug that in as well, 0.02. Let's do a little multiplication. So then on the other side, we'll multiply both sides by r minus 0.02. Then we get $50. Gosh, you gotta love the algebra on this exam. It is a fun time. $50 times r minus 0.02 equals 5.20. Okay, so then we get $50 times r minus 50 times 0.02, which gets us to 1, equals $5.20. Then we'll add this $1 to both sides. So then we get 50r plus $1 on both sides equals $6.20. And then from there, we are going to do $6.20 divided by $50. And that is going to get us to our final answer. I got 12.4. Sometimes you'll get answers that are not exactly on par, but the closest answer here is 12.2. And that's going to be our final answer. Again, keep in mind, the best way to not get tripped up by a rounding error is so r equals 12.4%. That's what I got. The best way is don't do any rounding until the very end. Leave your numbers in your formulas as lengthy as possible with all the decimal points, all the numbers there, and then at the very end round it. That's your best clear-cut way to not to lose points from a rounding error. But again, some questions will have you choose the closest answer, and that's something to practice, right? Because you wouldn't know that if you just read the textbook all day or listened to lectures all day. So practice, see what these questions have in store for you. Certain tests, certain types of questions, they may never have just rounding anything like this, right? You got to take a look and practice, but these were some wonderful questions. Practice them. Definitely memorize all these formulas because you can't apply them until you memorize them. Once you memorize, step 1 is memorize. Step 2 is apply. Memorizing just allows you to go into the test with the textbook in your mind, right? That's a very important step, and I hope you do that for your own sake. I would not go into the exam without having all these formulas memorized. Thank you all for joining, and keep going strong. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.